Is there too much optimism being priced into the markets right now?
No, I don't think so. I think everything that's come out of both the therapeutic front and the vaccine front over the first few months, so not just the past week, has generally come out better than expected in terms of the quality of the results reported by the major drug makers. So it is right to think about the vaccine as really sealing the case for this being the last major wave of COVID. And if you believe that that's the case, then you have to bet on a stronger global economy without a lot of volatility next year. And that's what markets are reacting to. So I don't think the medium-term path that markets are anchored by is justified at all. The shorter-term path is different because we're starting to see increasing lockdowns in the U.S. One has to think this has an impact on growth. This is going to cause episodic drawdowns in risky markets, but I don't think it changes the direction of markets over the next several months.
John, what kind of recovery are you expecting once we have the vaccine?
I think once you have the vaccine, keep in mind that in the background, there's probably going to be more fiscal easing by the time the vaccine is actually deployed to the general public. So I think that's why 2021 is going to be a year where the global economy is printing above trend growth, why probably most DM and EM economies are printing above trend growth. Monetary policy will remain loose. Fiscal policy is a bit of a drag, but not enough of a drag to really pull growth below trend. I think that's a pretty impressive environment for financial assets. I mean, yes, some of them are rich, but I think that richness just sort of constrains the upside next year as opposed to forcing asset prices lower.
John, you write hyper detailed notes at a professional level and institutional level. Let me take it back to the core question for institutions and for all of our viewers. What do you do with cash? How do you deploy cash in the land of John Normand?
So I don't think you should hold much of it simply because anytime the global economy is growing above trend, the bias on equity markets is higher. The bias on credit spreads is tighter. So, hands down, other financial assets, ex cash and ex DM government bonds are going to give you better returns than the safe stuff. That's the basic point of this. I think the question, though, is would you hold any cash at all? And I think you should, simply because many financial markets are extremely difficult to hedge in an environment where DM bond yields are already so low. So one cannot hedge with German bonds anymore, and there's a limited degree to which one can hedge with treasuries. So the only way to sort of limit one's risk over the next year is to have some residual cash position, even if it should be a small one. Maybe it should only be a couple percent of the portfolio.
John, I'm going to rip up the script and go all Bridgewater on you. Think of Bob Prince and leading this charge at Davos. It seems like forever ago. If bonds are useless as a hedge, if full faith in credit U.S. is useless as a hedge, has John Normand and JPMorgan come up with a hedge alternative, or is that essentially a constructive impossibility?
No, they're a bunch of second best alternatives. I'm not going to claim I have come up with them because they've been around for decades, if not even longer than that. So this is basic defensive assets in currencies like the yen or the Swiss franc. They're basic defensive assets in commodities like gold. And I still think treasuries have some residual value. They do not yield zero yet. They might only yield 90 basis points in 10-year U.S., but there is some scope for those yields to go down if the economy disappoints and the Fed extends the average maturity of its purchases. So bonds, I think, are definitely useless. So are JGBs. So are UK gilts. Treasuries have a lot less usefulness than they used to have, but that needs to be combined with some of these other defensive assets in currencies and commodities like the yen and gold.
John, where does the market find yield in 2021?
I think it's only in credit and emerging markets. Credit meaning high yield, high grade, I think has too much duration risk for an improving growth environment to make that a decent risk reward. So it's basically about high yield and probably EM local markets. I think there are still, if you have to find any central banks that are going to be easing policy next year, it's probably going to be those EMs that still have reasonably high real interest rates, Mexico, Russia, China, perhaps Indonesia. Those are places where people can earn yield and capital gains, but it's obviously just a subset of the fixed income universe compared to what people are used to thinking about as the yield options in this kind of environment.